Welcome to the Vinny Joe Show, episode number 4. New episodes every Friday at 10 a.m. Eastern. So today we're talking about two stocks. One of them was starting to get me excited again. I was starting to think about possibly starting a position in it, and we'll talk about that. The other one I'm definitely excited about and buying more. So the first company is Symbotic, which we've talked a lot about on the channel here. And the recent dock strike with the whole longshoreman union strike thing going on got me interested again. So even though that strike was resolved very quickly, it just got me thinking about the potential for automation here and how a lot of these jobs are inevitably getting automated away. And how even Rick Cohen, Symbotic CEO, on the Investor Day had said how he even thought Symbotic system could be used at ports. So I think that, there's a system with a lot of potential that can be applied to so many different industries, even just beyond the traditional warehouse. So all that kind of got me interested again. I piqued my interest and got me looking into Symbotic again. So I'll go through what I found, but I think there's a lot of issues right now that are keeping me from wanting to buy this stock. So let's take a look. First of all, on the pros, something really good here is the company's revenue growth. It's probably the one bright spot. You know, just the growth has been crazy. 2021, 250 million in revenue. They doubled it in 2022, getting up to just under 600 million. 2023 doubled again, just under 1.2 billion dollars of revenue. And then for 2024, it's looking like they might bring in just under 1.8 billion in revenue, which would be good for another 50% growth year. And then 2025, 2.4 billion. So, that would be 36% growth. So while the growth is slowing down, I mean, these are still monumental, amazing revenue growth rates. So let's look at some of the issues. There just continues to be a lot more selling than buying, especially if we look at the insiders here. All you see is sells. There have been 81 sells and 0 buys. And that's in the past year. So it just continues, even up to the present. As recent as the beginning of October here, we've got more sales coming in from insiders. So none of the insiders seem to be wanting to buy this stock, which always raises some red flags. And then if we look at the financials, so again, the revenue growth has been great. But if we look at something like the shares outstanding here, total shares outstanding is up to 103 million, and this is crazy. So they're issuing a lot of shares. You're getting diluted, and this is not great. 103 million shares, that's in under 2 years. 2 years ago, it was only 57 million. So you've gotten such heavy dilution here. This is not really great, and I'm not really sure what's going on there. So I was starting to consider the stock again, but there just seems to be a lot of red flags right now that make it not worth touching. You've got the dilution, you've got all the selling, you've got some class action lawsuits against the company that they misled investors, they're claiming. So I just don't really want to touch it right now. I was considering selling some puts at a lower price, to try and get in lower, but I'm kind of reconsidering. I don't even think it's worth doing that because there's just a lot of things up in the air right now at the company. So hopefully in the next quarterly report, we get some clarity. All right, so that brings us to the second company I wanted to talk about, which I made a video on a couple weeks ago, is Carnival Cruise Lines. Now, everything wrong with Symbotic is going really well for this company. So they just posted their third quarter report. It was a record-breaking quarter. I had posted a video on Carnival a couple weeks ago, but this is a company I think is poised to do very well. They just posted record revenues, record everything really. They outperformed their third. Excuse me. They outperformed their third quarter guidance on every measure, and they continue to have to revise their guidance up for the year. So this is the third time they had to revise up for the year. Good problem to have. So they just continue to beat on all their own expectations. And you see here it says improved guidance, enabling us to drive more revenue to the bottom line and achieve around a 10.5% adjusted ROIC. So it's interesting that they use adjusted, but ROIC, return on invested capital, is a really important metric. There's a great book that goes into this called 100 Baggers. It's all about finding stocks that could, 100x But one of the things that they look for is stocks that, if they can consistently put up double-digit growth rates alongside double-digit return on invested capital, you have the makings of a company that is going to go up quite a bit. And their 2025 bookings have hit historical highs, so they're just really breaking all their own records here. They've got for 2025 already historical high on price, historical high on occupancy. Nearly half of 2025 is already on the books. So it's looking very good. And, this is a great sign just for whatever happens with the economy here. If we were to go into a recession, the fact that they kind of have this to carry them through 2025 already, with much of it already booked, is great to see. Customers are booking further and further out. So they've got record customer deposits. So that just keeps going up. 6.8 billion for Q3 2024, which was up from 6.3 billion of last year, or the last, if we look at Q3 of 2019, the last year things were kind of normal. It was only 4.9 billion. So if they get this money ahead of time, it helps in many ways, and it can kind of help them to pay down the debt, which we'll look at here. So this is the other thing that's very interesting with the company is the whole cruise industry. Carnival, companies like Norwegian, was obviously decimated by the pandemic, and it forced them to do a lot of share dilution, and also take on a lot of debt. So Carnival's debt peaked at around $32 billion, but they've since started paying it down. So since the beginning of 2023, they've paid back $7.3 billion of debt, and this is high interest rate debt as well. So you can kind of see here, they paid back 1.6 billion, 7.6%. Interest rate. 2.1 billion had a 9.9 to 10.5% interest rate. So they're getting rid of this high interest rate debt, and that's obviously going to directly benefit the bottom line. So they continue to kind of prepay this debt, and as a result, their credit ratings are going up, and they're expecting that their substantial free cash flow will enable further leverage reduction over the next several years. The other thing that I think is great about the cruise line industry is it's not like you have a hotel that's in a set location. You've got ships that are mobile, and it's an international company. So they're kind of able to pivot, if they would need to, whether it's, seasonal or just issues in the world, whatever's going on, these ships can just go wherever they need to be or wherever the opportunity is. And as you can see, they kind of have a pretty well diversified balance here. It obviously changes seasonally, but in all different regions of the world where they're deriving revenue. As I said, Carnival's debt had kind of peaked at around 32 billion. They've already paid down over $7 billion of debt, and their long-term debt is down to around 26 billion now. So I think the cruise line industry is a great area that is just poised to continue growing. It's the fastest growing tourism sector, continues to do very well, and I think it just gives you a lot of value. If we were to hit a downturn, cruising is still pretty affordable compared to other things, and just the ease of the whole experience. It's a great industry, I think, that's going to continue to grow, and companies like Carnival are going to, reap the benefits. So let me know what you guys think in the comments below of Symbotic and Carnival. If you enjoyed the video, don't forget to like and subscribe. I'll see you guys next Friday.